Oh yeah, hi, I'm Evan. Nice to meet you. I'm one of the co-founders of San Francisco Compute. We make a compute market. So we're building a regulated commodity exchange for like trading compute, basically. So that's sort of my background. This entire talk is about the generally like how a GPU cloud thinks about compute and how that leads to basically like the price of the GPU hour and like where that comes from. So we're going to start by like making a GPU cloud. So we'll give our VC pitch of a GPU cloud, which is like pretty much every single VC pitch of a GPU cloud ever. And it's going to be this is like our plan. We're going to go buy GPUs. Then we're going to build like really great software on top. That's going to be our margin. And then customers will reward us with higher prices. So there's the underlying cost of the compute, and then there's like stuff we're going to do to differentiate ourselves in some way or another. This is pretty much what you go in to like every GPU cloud ever has pitched this exact pitch to many VCs and so on. And this is like, then there's like the hyperscaler pitch for every GPU cloud, like how a hyperscaler might go out. So not a startup, not a neo cloud, this is what they would do. And so here's our plan. They're going to buy GPUs, and they're going to build great software on top. And then the customers will reward them with higher prices. And so they're gonna have the underlying compute costs that they're gonna sell. And then they're gonna build features on top. And that's their plan. Cool. Let's see how it goes. So here's the issue, and like why everyone thinks you can do this and why like it doesn't necessarily always work out for GPUs. In CPUs, so this is like web servers, traditional cloud service providers. Your ROI for the customer when they buy from you looks a little bit like this. You like buy enough to get to you like run your web servers, you like set up your SaaS app or whatever, and now you've got enough compute to the point in which you like don't need any more. Because if you're like building random SaaS app, then like adding more web servers to your random SaaS app does not improve your amount of money. Like it doesn't give you anything more. If you're like Salesforce and you like add more servers that like run Salesforce, you know, like make more money. You make more money by like selling more Salesforce. In GPUs, there's this sort of other curve, and something's definitely like messed up about this one over here. Don't exactly know what's going on there. I'll let you all figure it out. Basically, the ROI on buying GPUs for training looks a little different, which is that if you start with a small model, and now you have bought enough compute to train your model, you don't just like stop. In fact, you actually want more GPUs to make an even bigger model. And for whatever reason, this seems to continue for quite a ways. And this is like very distinctly different than what you would do in a web server. So there are a lot of folks out there who kind of like pretty much all the hyperscalers, all the neo clouds kind of went out and pitched what looks like a CPU cloud, thinking that they could do the same thing in GPU clouds. This doesn't really work because this is, you can kind of reformat these graphs into like what the amount of money the customer has left over after they have spent all the money on compute to give you. And that money is your opportunity for margin. So in CPUs, like the customer wants enough compute that to that way they can like launch and get their product online, but then they keep making money. So their like business keeps growing and their underlying hardware needs like doesn't keep growing. They just continue to stay. So all the money that they have that's in between those 2 points is the money that you can charge as extra stuff. So this is either you can charge more per CPU hour or you can charge like for features or whatever you want. This is like where all your margin comes from. So like in GPUs, this like definitely is not the case because the moment you come back, the moment you like train your first model, you want to scale up, and basically you have an entire budget, and you're going to maximize your flop per dollar. And that means that you, as the customer, are super price sensitive. You don't care like who you're buying from, and you'll go with whatever the cheapest thing you can get as. And that means that for you, the GPU cloud, you functionally have no margin or like very like slim margins that you can actually charge on this. So in other words, it's very hard to do the model that is the one that's traditionally pitched by hyperscalers and VCs or like startups pitching to VCs in that like, because it like works in software, it works in CPUs, where you can make software on top of your CPUs and you can make margin. And your actual costs for your CPUs under the hood are not very high. In GPUs, what happens is like your customer requires you to spend way more on CapEx but then also independently super price sensitive, so they push your margins to as thin as possible. Which means that the traditional model in which you would like vertically integrate your hardware and software and GPUs, basically build a cloud provider, like functionally does not work at all. So pretty much everyone is losing money on GPUs, unless you do one of like three things. So you can notice that anyone who does not do one of these is like losing at the moment, is all like they're losing money on their GPUs. So like one option is that you can make your own chips. NVIDIA has fat margins and you can squeeze into NVIDIA's margins. Or you can move up the value chain. So you can train models and then sell products on top of that. So like ChatGPT makes money. Or you can make ML infrastructure that is not like dependent on the GPU under the hood. So you can only sell software and you don't have any hardware yourself. There's nothing on your balance sheet. Or you can do the third option, which is you can correctly price risk. So this is like the graph of interest rates. So this is assuming like a bunch of different things. But the general gist is that like your probability of default and like how much you're going to lose if someone defaults. So this is like what a lender would look at to say, okay, here's what what interest rate I should charge given this situation. You can sort of like map this graph onto how you should price your GPU in order to like not lose money. In this case, this is what you would need to do just to break even, not to like make any extra money on top. So you can kind of think about this like the probability that you're able to sell GPUs and how much they'll depreciate if you don't sell them by this time. Or similarly, you can think about it in 4 different categories. You can think about it like if I have some GPU contract. So GPU contracts are typically sold over like you can do 1 GPU for an hour, or you can do thousands for like 3 years, and you pay all up front. And so this is like the range of things that you can do. So if you are over here and you're doing what is something like what a CoreWeave would do, then you're selling you're doing large contracts paid up front, and that means that your probability that the customer is going to default is basically 0 because they've already paid you. And then your loss, which is like if they did default, like where would the GPU price be then given the depreciation curve be? And the answer is basically 0. So what this means is that you pretty much have no risk here, and so you can charge pretty low prices, which means you actually win on the cost game. So because the customer only cares about price, because you don't really have the ability to sell software, because it's the whole previous thing, like if you can get here, you'll win. The problem of this is that most people don't like to pay large contracts and they don't like to pay up front. And pretty much there's only a few vendors that will actually do this at any reasonable scale. So what happened is like a few vendors won this entire market and sold the big contracts to the people who would buy the big contracts. And now folks try to squeeze into the other parts of this. And so if you're over here on the top left-hand corner, you're selling large contracts that are paid over time. This is a good way to lose money. If you're over here, you're doing short-term contracts paid up front. This is not too terrible way, but you still might lose money because if you're only selling week after week, you always have to wonder who's going to buy the next week. And if you own the GPUs and you have a loan that's like 3 years, and you're only selling to customers in these like week-long chunks, or you're selling like per hour basis, then like depreciation curve is going to happen, and you need to deal with that. And then similarly, or sorry, this is slightly different. This is actually more what I'm referring to. So if you have, let's see. Yeah, okay, whatever. So that is, for the most part, the end of this part of the talk, because it's a very short talk, I guess, because I didn't know how long 30 minutes was. Because this is like, our general community, I'm going to end with a bunch of predictions that are poorly made and quite loose. And we can base this on like who's going to work and who's going to not work. So Evan's prediction number 1 is CoreWeave is going to make lots and lots of money. The reason why CoreWeave is going to make lots and lots of money is because they sell all their contracts in like long-term things and very large chunks, and they get paid mostly upfront. So they pretty much have no risk. And so because of that, they were able to go and get really low interest rates and then go back to the customers and charge money that is more money than their capital costs. And they kind of just said like, fuck it to building anything else on top, which is like the correct strategy. And if you can do this strategy, it's a really effective one. And so CoreWeave is going to make a lot of money. Lambda today has 512 H100s that you can buy on like a per hour basis, more or less, kind of. And my general prediction is it's going to lose money. Mostly because Lambda tries to push down their total costs in order to be perceived as like the cheap option. But if we like go back over here, functionally what they're doing is here. And what you should be doing if you're correctly pricing the risk is charging as much as you possibly can. But they're definitely not doing that. And so odds are they're going to lose money. DigitalOcean and Together are doing the thing that they probably shouldn't have been doing based on this, which is that the vertical integration of GPU clouds doesn't really work. And the reason, again, why it doesn't work is that if you build software on top of it, and your software is like, super great and amazing, and it's this really great cloud platform, it's the DigitalOcean experience, it's Together's like beautiful, or like all their sort of shotgun strategy. Like, if you have that and you say, oh my gosh, my customers are going to reward me with higher prices, and so I'm going to charge 10% more on a $100 million contract, that's $10 million, and you can just hire an entire engineering team to sort of say, like, rebuild basically any software you build. So functionally it does not work very well. And so my guess is that if you're DigitalOcean Together, you have just turned a fantastic software business into a really bad hardware business. And now you are, my guess is that they are losing money on their clusters, and they won't make money, recoup the costs that they bought. Similarly, the opposite of that is like a modal and a replicate. So these are other ML infrastructure providers, but they don't own the underlying hardware. Because they don't own the underlying hardware, they like just make money instead of losing money. And their prices are a lot higher, but they're pretty much only saying from any, like on a per unit cost basis, they make money, which is better than not. It's nicer. Yeah, okay, that's questions. It's my very short talk on GPU economics. Thank you. Cool.
What is your company doing based on all of this?
Oh, right. So we're making a commodity market. Our goal is basically to let people sell and offset risk. So we want to eventually get to the point where we can do futures and options. To do futures and options, you need this thing that's called a DCM. It's like the license you would need to sell. We're like 3 years to 8 years to get a DCM. Maybe the new administration changes that. So we're likely going to work with another party. In the meantime, we have a spot market, and that's functionally lets you sell off chunks of blocks like this, like chunks of compute, and that helps you sort of spread out your risk. Importantly, it also lets you build a software business on top while getting cheap prices. So if you're like a modal or you're a replicate, you can buy directly from SF Compute on a sort of the market price, and you can just pass on the market price to your customer and take a spread on top without you owning the underlying asset, which means that you don't have to take on any inventory risk, which means your business makes money instead of losing money. So that's what we do.
Yeah, thanks for going through all that. This is going to be a bit remedial, but just to like synthesize, like if you feel like you're someone in the GPU provider, the fee that they're getting paid for over and above the underlying FX cost, what would you call that? Is that like your ability to manage interest risk as you kind of frame it? What is the actual thing that you were earning, higher than the profits?
Indeed. Very good question. Okay, so you're asking like what is the thing that is the service you're providing on top of the GPUs that provides some sort of margin? And the correct answer is that like most folks don't have a service that is valuable enough to account for just a cheaper underlying cost. So most people's service, like their sort of easy pitch, is that they're going to build like the ML training platform in the future or some genre thing like this. Maybe they have a really great instance provider or something like this. And they're providing, developer experience. They're providing, optimization for you of some sort. And the problem with this is that if it's just software, pretty much any reasonable amount of margin you would want for your software business is going to be like maybe maximum you say is like, minimum that it would be reasonable for you to charge is like 10%. But 10% on a $100 million contract is like $10 million, and that's not worth it for software. Basically, pretty much any like that's pretty much where like enterprise contracts for pure software tend to cap out at. And so because of that, because like if you that $10 million that you paid extra to your GPU provider, you could have just spent like $5 million with that and then hired a software team or like a bunch of engineers to like build and replicate that exact same thing. So what you're better off doing if you're a GPU cloud is actually just selling at the lowest possible price you can. And instead of like trying to build services on top, you're better off optimizing your risk, which is the marginal cost of compute. And that lowers your underlying costs, which then actually lets you compete on the market. And so if the market price is, $3 or something, and you can, do like $2.85 or something, you will probably just like win. Or you'll make more money than if you were to try and charge $3.20 by selling software and up.
That was the thing I really needed to go for, but didn't have one. Oh, wow. Amazing.
Report is right behind you.
I see. Yeah.
How fungible are the assets in your marketplace, and to what degree do you sort of create the abstraction layer versus leaving that to the buyer on the other side?
We think it is relatively fungible. So the parts that we think are not fungible is one, like time of when you want it, but this is the same sort of functionality as a lot of other markets. The other thing that's fungible is like or something that would be hard to. The other problem here is that you would need a bunch of compute in the same cluster is distinctly different than a bunch of compute that's like in various different places. So being fully interconnected is different. And then there's the problem under the hood of like all the clusters are like mildly different. The hardware setups are different on all of them. Some of them are just like completely broken. There's like different security requirements on all of them. So this is what we basically create like a category class of a rule book that says you have to have exactly the spec or better. And we go and basically do sample approval that says if you buy this, it has the specs or better. And we've gone and audited the cluster.
So does that cash out to inference is way easier? You do inference basically.
Do we do
training as well?
Yeah, we do training. That's our primary thing. Yeah.
But you said that is a lot harder because you need to connect.
Yeah. So the way our market works, the market understands the difference between it's not different. The way the market works is that if you have like one big block of compute, yeah. If you have like one big block of compute, it's in a single data center. That is a distinctly different contract than the same amount of compute split across a bunch of different blocks. So these would all be priced differently. But you can imagine me throwing more of them.
So who's the sell side of the market? Is it people that have bought clusters that they realize they don't necessarily need as much as they thought?
So we look back up at the folks who have gone and done a lot of people who thought they were going to make this, who turned out that they were going to make this. And then this price went down. And now they end up with a lot of GPUs that they can't really sell. And so they need some way to sell them, typically in chunks that are different. So today we look a little bit like Hotel Tonight for GPUs, because there's a bunch of folks who have GPUs on their website. They would like to say $3 an hour, or maybe even $4 an hour. The market price for GPUs is not $3 an hour, $4 an hour. But some people will still pay it to them because they don't really have access to the market. And the other people will just not buy from them. So in order to prevent their like branded channel from dropping their prices, they sort of privately sell on us. And so it's all the players do the thing. There is very much a market for that. In the long term, we think this is just the correct way to sell compute. That the model of the past in which you had a competitor who had this vertically integrated, had software and the CPUs and the hardware on their same balance sheet within one company is a very bad model for GPUs. As we think the market will disintegrate or disintermediate, where you will have like companies who provide basically pure software and companies who provide pure hardware.
I recognize that you're seeing a meaningful glut in the gaming market. I'm curious about where there are pockets of demand that are still radically underserved. And that could be like compute particularly secure things, or I don't know, where are the pockets of demand that are underserved?
So a few things. One is super high security compute, so stuff that needs to be in an aircraft environment, this genre of thing. And then I think this is feasible to do if you just price risk correctly, but nobody's doing it correctly. The only people who are doing this, I think, are just going to lose all their money, because I don't think they're pricing risk correctly. They're instead functionally subsidizing this. Like, instead of charging them a higher price that they should be, they're subsidizing it with VC dollars. And I think that's going to go poorly. But
They don't have a product on the back end, so strategically,
if that blows up, then I think this is a place where you could build an area. And then the other thing is just if you need a very large amount of, like a big training cluster, one in which you need to build your own data center for, like a new data center for, one that's like, I don't know, like SAI cluster, for example. I think it's, so like the largest end of it, though this problem still exists in that, it just gets shut down to the like letter piece of it. So it's something like a magnet.
I think we have from the loop. Everyone, please drop me a like again.